Thank you. Hi, I hope everyone is doing well and keeping healthy. Thank you for joining me for this introduction to AIPEX. This is my third or fourth week into the Canadian quarantine. I'm up in Toronto and I'm quickly losing track of time. I just want to start by wishing the best for everyone here, your friends, your family. These are surreal times, and I hope, if nothing else, I offer a bit of a distraction for you today. I'm Rob Fleischmann, and I launched AIPEX about 6 years ago. It's an idea I've been toying with for about a decade. Today, I'm going to show you an AI management system. Really think of it as scaffolding that allows you to build trading logic without the programming chops. I'll show you some examples of the syntax, and I'll explain how AIPEX was able to prospect and execute over 80 trades on NASDAQ for a fully automated profit of 1.15% in March. NASDAQ dropped over 11% for the month and 14% for the quarter. And yes, we're also down for the quarter. At the moment, we're at, I'm just taking a look, 1.16% down for the year. AIPEX was caught in February with everyone else when the coronavirus picked up steam, but it switched gears immediately, and I'll talk about that too. Before I get deep into it, I'll give a quick review of the past, present, and future of trade execution. Then I'll describe AIPEX and how it fits into the evolution of automated trading. I'm hoping to leave at least 20 minutes for questions at the end, but I'm probably going to go all the way to the end, I suspect. If I do, I promise to answer the rest of your questions offline, no problem. We've run out of time. So first, we start off with the usual disclaimer. Trading comes with risk, and in particular, using our signals to trade may be a problem for you because you're dealing with something called internet latency, and it could become a factor. You may not get our signals in a timely fashion, depending on your connection to the internet. AIPEX is meant for informational and educational purposes only, and all trading comes with significant risk. So to start, here's a little something to think about as I continue. In 1964, Marshall McLuhan described how a message and its mode of delivery are related. And today, I think there's a similar relationship between data latency and its value. It's the crux of how AIPEX works, actually. Today, world news is relayed in near real time. Market data is delivered in microseconds. And the state of change in world markets is completely fluid. It's the old saying, the news isn't getting worse, the reporting is getting better. So today I'll talk about past trade efficiency and algo advancements, how fund managers got blindsided by quants, and why trading the market sometimes feels like treading water. And finally, why AIPEX is a game changer and how it levels the playing field for everyone. Let's start with a quick refresher on the history of trading. I broke it down to its speed on the left and its method of delivery on the right. In the early 19th century, your quotes came from newspaper and you placed your orders directly as the crow flies, but that's by carrier pigeon, in fact. Coming into the 20th century, copper wire delivers quotes to wall-mounted displays where the name wirehouse still sticks today, describing a full-service broker. In 1972, NASDAQ is opened. And NASDAQ, by the way, stands for National Association of Securities Dealers Automated Quotations. And at first, it really is just electronic quotes. There's no trading initially. And then in '87, NASDAQ answers the frustration felt through Black Monday by offering the small order execution system. In the 90s, Globex introduces after-hours electronic trading for multiple markets, and Terra Nova comes up with order matching to bypass NASDAQ commissions as their SOS execution grows. And Daytech puts SOS on steroids when they hire two guys, actually teenagers, Josh Levine and Jeff Citron, to cut trade times down to seconds with the original high-frequency trading platform that they called Watcher. Coming into the 21st century, Quotes are moved from fractions to decimals. I don't know if you guys remember in the newspapers when we used to see the fractions for each quote. It doesn't exist anymore, but they make things easier for the retail investor and their computer too. By the end of the first decade, HFT trade latency is cut 1,000-fold down to milliseconds by changing their plumbing to fiber. And in this past decade, HFT speeds advance 1,000,000-fold, skipping past microsecond territory before jumping to nanoseconds, first by way of microwave, and then, when the weather got in the way because it interfered with the microwaves, they opted for laser delivery of their quotes and trades. At nanosecond levels, they're at the limits of data transfer, pressing today's computer circuitry to keep up. Now, the takeaway is that for the past 50 years, the market focused on trade latency, getting the data to the user and executing their trades as quickly as possible. When talking about advancements in algorithmic trading, you have to look at its foundation, starting with computational advancements. Big data is easily handled with an unstructured database like MongoDB, and Hadoop lets you distribute the processing of that data very quickly. Programs are written using structured code that's compiled for speed, and languages like MATLAB, Python, and R are well suited for statistics and AI. And when your computer isn't fast enough, you turn to the GPU, or graphical processing unit. Your program software for the GPU using CUDA, which was developed by NVIDIA, by the way. It allows you to send your arithmetic off to your video card to be processed and returned to your main program. And then you have the mechanical advancements. As you've seen, the conduit that delivers the data is moved from copper through fiber, microwave, and laser. Plus, thanks to Moore's law, since the 1960s, we've been tracking a doubling of computer power every 2 years at a 50% reduction in price. A year ago, I built what I call the AIPEX Mission Control Server. It's a 32-core AMD Threadripper chip for just under $12,000. The specs on this machine are ridiculous for that money. It's basically 8 mid-tier servers rolled into one. The 1080 Ti GPUs, that's what we're currently used for our analytics between each tick. We buy them up cheap from the crypto farmers whenever they upgrade their GPU stack. When you really want to compute something quickly, what you do is you divide up the process and run it in parallel. If you move the analytics off to a GPU like this one, you'll have over 3,500 cores to play with, each one handling a part of the computation at that same time. Each of our 10 servers in the lab houses a GPU that can execute thousands of formulas in a fraction of a second to keep up with the tick flow of a very liquid exchange like NASDAQ. So now, let's talk about the limitations of these advancements. Databasing to disk, even SSD or solid-state disk, is only useful for offline storage, and that's because you can't keep up with the tick flow of a high-volume exchange unless everything lives in RAM. While structured programming requires an expert skill level to master the coding that will get the most out of your computer, network, and peripherals, often you have two camps in an algo trading house, those with the coding chops and those with the stats background, because it's rare to have a senior software engineer who's also a PhD in quantitative analytics. And if you thought structured code was tough, try programming in assembly language to use your GPU to its fullest extent. Now, onto the mechanical side. We can't transfer data any faster than the speed of light, or so Einstein tells us. So we're kind of up against that wall. And it's difficult to introduce data distribution for an event that you're expecting chronologically, like a stock ticker. With the CPUs, there are limits to how small we can go for the size of the transistor. With advancements in die casting, Samsung is aiming for 3 nanometers, which will give a 30% boost to the performance over 5 nanometers, which isn't even expected out until 2022. We're approaching subatomic scale, and we don't have the manufacturing process to build them yet. And GPUs, they face the similar limits as CPUs with the added bonus of heat. Remember, the number of cores is exponentially higher than the CPUs. And with as many GPUs in a farm, like crypto mining, heat dissipation is a real factor to consider. To compete with today's best quants, the skills required to program a structured language at the master level are out of reach for most traders. And the most successful quant hedge funds like Renaissance Technologies have several dozen PhDs among their 200 staff to guide their software engineers. In the future, when AIPEX moves out of the lab, it will be based on AMD Genoa chips that are coming out in 2022, the ones I mentioned. And that's what we aim to give access to in the cloud when we offer up AIPEX as an AI development platform for everyone to code and trade their own algorithms. We will handle all the computational and mechanical heavy lifting for you, and will give you the tools to program like a pro by using AIPEX pseudocode to write your own AI. Quants introduced a new way of looking at the market. They focused on the mechanics of the trade over the fundamentals of the business. While watching over profit, managers ignored the change in process that quants brought to the table. Programmers like Josh Levine often applied the same binary view of things as they would for any of their work. The idea is to win by any means necessary because it's all about the outcome, not the effect on world markets. With very little trading experience, HFT coders fell back on brute force methods for tiny profits at high speed. And that can't change because of how fast they execute the trades right now. And with HFT trade flow, increased liquidity and narrowed speeds allowed them to point to their boost in market efficiency to defend their existence. So why aren't we all using HFT? Well, first of all, it's very expensive to set up for computers, direct bandwidth to the markets, coders, quants, and office space right next to the exchange servers. And then, with just a handful of HFT players, their huge trade volume squeezed volatility and shrunk their market size by narrowing spreads. So any new player is late to the game, and they're scrambling for a share of a much smaller pie. By driving trade efficiency, quants made computers a requirement to compete. Most trading is done with the help of a computer today, from logging on to your accounts to looking up quotes, research, and charts and news. We're using robo-advisors, charting software, drag and drop templates, or set and forget trading bots. But fully automated stock trading with advanced strategic execution, the real deal, is out of reach for most retail investors. The closest thing is to sit down and start coding your own from scratch, which isn't easy without a software company to maintain it. AIPEX can execute 6,000 trades per minute. And though it's not HFT's 10,000 per second, I'm pretty sure you'd have some difficulty keeping up with at least 60 positions at once. We're ramping up, and we hope to raise our capacity to manage 300 concurrent positions by the end of the summer. And the more you try to manage, the worse your reaction time. There's a reason they hand out tickets when you text and drive. Today, day trading without a decent computer is a non-starter. So how do we trade against these machines? Well, we're holding our positions longer, and we're favoring swing trading instead of day trading, tops and bottoms against an algorithm. It also helps your emotional self to set longer time horizons and relieve the pressure of a near-term trade window. It gives you time to think instead of getting lulled into a false sense of urgency because a computer is pressuring you to react. Some switch to other exchanges where AI is rarely found. I wouldn't recommend trading on an illiquid exchange though. It's not worth it. I can tell you from experience, a much earlier prototype of AIPEX was set up to trade OTC markets, believe it or not. And we broke even after 2 years of trading. But you're better off in Vegas, especially now with the wind closed. Now, all you have to do, or what's happening at the moment, is that people are just handing over control of their portfolio to, you guessed it, another computer system. We're talking about index funds, ETFs, and mutual fund investments, robo-advisories. They're balancing your portfolio, again, based on ETFs generally, and large firms or hedge funds that, again, drop your money into their algo division. RIAs are pretty solid, but they also look to ETFs, and so the money's probably going back to a wirehouse by the time you're finished. So past R&D for the markets was focused on tech behind trading efficiency. Over the years, we've seen huge advancements in software, data acquisition, and management. And hardware kept pace with near zero latency and supercomputer speeds on your desktop. And machine learning? Well, that's opened the door to scaled automation, as I'm about to show you. But what happened to trading experience? Well, experienced traders understand timing, arbitrage, macro news events. They can understand the nuances of insider trades on this symbol or its competition, whether a takeover offer is real, and if the market priced it in or not. Experience can piece together the big picture much faster than a computer, unless it's named Watson or DeepMind. And most of us don't have access to those guys. George Soros famously said his animal instincts include acute back pain. That tells him when to change position on the market. It's an instinct that's based on decades of experience, and it produces a physical reaction that he has no way of explaining. He only knows what it means. Old school traders have a sixth sense about them. They can approach the market as though they've been there before. And their recall of past events is what saves them in the here and now. Cataloging those experiences for the programmer is easier said than done. And more often than not, the two personalities clash. And usually, the old dog is let go to make way for the quant's new tricks. The AIPEX platform is a pursuit of efficiency. And the quant removed the human trader from that equation. The latest AI learns from its mistakes. With a perfect recall and flawless execution, mistakes are not left to interpretation. It doesn't care if pulling out of the market leaves a vacuum that triggers a flash crash. That's fine, so long as its own portfolio is protected. And after learning that a crash leaves strong buyback opportunities, the AI is free to interpret the result as favorable and worth repeating. Quants write algos based on observation, statistics, and backtesting, while traders use intuition, experience, and wisdom of the masses. Machine learning is often run through mountains of historical data, looking for repeatable patterns based on a myriad of assumptions that can lead to curve fitting or worse, as it often ignores the possibility of a black swan event. Both of the famous quant funds, Renaissance and Bridgewater, have been running these models for decades with world-renowned returns. This past March, they were both down over 20% year to date after failing to quickly adjust for the hit in February. AIPEX is programmed to make course corrections based on predictive behavioral sentiment. Just like a commercial flight, there is a continuous reassessment with each tick, keeping every trade balanced, rewarding trends, removing losers, and keeping a close eye out for significant volatility within each symbol, sector, and exchange to mitigate risk. It's designed to handle hundreds of positions at once for both capital and risk distribution. It's fully isolated from multiple black swan events. Think bankruptcies, CEO scandals, lawsuits, mismanagement. Even crashing one or two stocks will hardly affect the portfolio. And this is why AIPEX drawdown for Q1 was 2% against NASDAQ's drop of 32% between February 19th and March 23rd. What AIPEX does naturally, what I simply call course correction, has a new name on the street. an article by PhDs Alex Lipton and Marcos Lopez de Prado mentions the 3 quant lessons from COVID-19. And in it, they describe the need for more nowcasting based on more real-time data and instant decisions. Exactly how AIPEX was designed from the start. Instead of the price time series based on cross-sectional data for forecasting, and that's how most quants trade today. I believe that removing traders from the equation was wrong because I put high value on the role of sentiment in the creation of an algorithm. Just like Sorrell's description of reflexivity, where the exposure of a trade placed can reflect back in the market price. The exclusion of sentiment in any algorithmic design leads to a sanitized by the numbers market execution, which will likely announce itself to the world by hitting all the greatest hits, 20, 50, 100 SMA crossovers, perfect overbought, oversold triggers, 30, 60, 90 support resistance levels, Fibonacci retracements, and so on. The soul is missing from the code, along with the ingenuity and unique personality that sets it apart from most other robotic execution. Determining an algo's shelf life is easy enough for any computer to assess. However, that's where its ability ends. Without human input to alter the algo, tweak it, and move it forward, it's reached the end of its life cycle. And breathing new life into an algorithm must come from a truly random source, not another algorithm. A veteran trader would stay off the beaten path, lest he announce his intentions to the market. The trader reflects a randomness missing from CPUs, and that volatility needs to bake back in to the strategic DNA of any algorithmic tweaks moving forward. And keeping the veteran trader in the loop ensures their experience and humanity is reflected back in the tweaks made. AIPEX is all about leveling the playing field for the average trader. We're giving you the tools to really compete with Goldman Sachs and BlackRock. You build the logic, and we provide the programming, prospecting, and fully automated trade management. Forget tracking 5 or 10 stocks. Why not look for intraday opportunities in all of NASDAQ every 5 minutes? We're doing that now, in-house. Our Signal subscriber pool is what gets this out to the cloud for everyone. And here's what you're looking at. On the left side, you can see the live trades that have occurred. And actually, what I'm going to do, nope, I can't do that because I can't share I couldn't share the screen. I could only share the application. I thought I could do this. I was going to bring over the screen that shows you how we're doing today. And in fact, at the moment, we're up 0.2% today. I'll just tell you, at the moment, we have a total of 10 wins, 1 loss. This is for April. We have a 342% win-loss multiplier. I think the last presenter mentioned you want to take a look at the average win divided by the average loss. That's how we're doing so far. And the system at the moment is net short, and it's bearish. On the right side, you're looking at the portfolio standings as of last night. So we had a few winners in there, as you can see. And that's the neat thing about the subscription. This is what it gives you access to. These alerts on the left, where it says trades today, you're going to get an alert as soon as AIPEX makes a trade. And that shows up in the portfolio, and you can see how we're doing. So you're basically looking over the shoulder of AIPEX as it's trading. So we decided to bring the traders into the world, to do this, to bring the traders in the world of quantitative analytics. We had to either boost your programming ability, or we had to boost your skills in statistical analysis. And since we can't fudge a PhD for you, we had to do the heavy lifting on the programming part. Structured programming languages come in all shapes and sizes, but they have one thing in common. They take a while to master, especially for the stats required for quantitative programming. Now, you can write your own formulas as simply as you want, like the one shown here. You can start to implement more sophisticated ideas if you want to. AIPEX can be used any way you can imagine. Think of a simple formula. In this case, you're comparing the day high with the maximum of the prior end of day closes, the prior 5 days. That formula right there, that one line does that. And you see the results at the bottom. It's saying that the result is 0, meaning it's not true, that 14.3 is not greater than the maximum of the past 5 days closes, because obviously you can see 14.66 is hit there. It's just like programming a formula in Excel. That's what we put together. There's no structured code necessarily. But if you want to get deeper, we can also allow you to get to relational formulas, historical data lookups, historical trade lookups, nested looping, and even recursivity is fully available to you in this very basic structure. There's nothing left off the table. I give you the game board, and you decide to use it either for checkers or chess. There's no right way to formulate with AIPEX. And what I just wrote there, that one line, it generated 192 lines of structured code, and that took about 10 seconds. Okay, it's fully compiled and ready to execute on the GPU trading farm. So there you go. That's what that one line generates. Now, when you're creating formulas, they can call other formulas in the system. That's where you get your structure. There's a patent pending tree view, which is what you're looking at right now. And that's what a program, if you will, that's what one of our programs looks like. This is just a small formula, and it's regarded as a template. It's easy to understand, it's fully visual, and it's very easy to trace and debug. So what's happening here is a formula called early falling calls a formula called downward, and downward calls a formula called average B and average A. And what those formulas are is the average bid and the average ask, and the downward determines whether or not things are moving downward. It's asking if the bid is less than the average bid over the past little while, or is the ask less than the average ask. And it's, you know, it's typical. Your highs are moving lower and your lows are moving lower. So it's looking for a channel. And that's what determines if it's early falling. Why is it early falling? Because the clock has been set to look at 9:47 a.m. or prior. That's simple. So these formulas you can put together on the fly, and there's really no structured coding to it. We do the rest in the background. Robian's spreadsheet simple approach means that users only need to understand the basics from math class, where formulas trigger each trade decision based on their Boolean result, true or false. Why complicate things? It's a visually based design. And because pictures get the point across, Robian allows you to back through history a tick at a time. And when you do that, you see your formulas light up like a Christmas tree. It's really neat to watch. You're actually sort of staring at the MRI for the AI system itself, and you're seeing when its synapses are triggering. So what you can do is you can isolate the ticks that occurred at the bottom of a trough, and you can see if your formula is triggered correctly or not. It's a totally different way of looking at programming. And the way this came to me, by the way, I don't know if you've ever done this in the past, but I used to put together comics on the corner of a page and flip through them like that. What occurred to me is I could stop time if I allowed you to write the coding like this. So you could isolate any instance, any point in time in a chart and see if your logic is working correctly or not. It's amazing, and it's very, very quick to use. The behavioral analytics that I wrote comprises of about 1,400 formulas, and all in that took me roughly 30 days to write. Okay, and that's what's generating the returns right now. And that's it. I hope you you enjoyed the presentation. We will have a coupon going out for the Tech Wizards presentation, and it's on the way for a further 5% off of the discounted price for subscriptions. I'm giving away a year's access for $300. That's discounted from the $30 a month. And for the $300, you're getting full access to the trades as they occur, to the signals, And you're also getting access to the prospects that are generated on a nightly basis. And as we get that up to the 5 minutes interval that I talked about before, that'll be included. And what's also coming down the pipe will be your ability to craft your own watch lists and allow AIPEX to trade them for you and give you signals on the symbols that you have in mind. Now, at the moment, I guess, well, when I first started talking today, we were at negative 1.26% year to date. We're now at negative 1.1. So AIPEX is going in the right direction, while NASDAQ has fallen so far 1.14%. I am putting a little something out there. I'm going to, for everybody that signs up for the annual, for the 300, while we are in the negative, for each month that we are still showing a negative amount, the overall P&L, I will be extending your anniversary date, your annual anniversary date by 1 month. Basically, you're getting that month for free until we start showing a profit. That's how confident I am in what we're doing. That's about it. I hope that I hope you enjoyed it. Let me see if there are any questions here. Please explain the conditions used to clarify weekday 4-hour trend. I've chosen 15 minutes, 5 minutes. Okay, so this is for Jody. I'm looking at the wrong questions. Okay, no questions. I don't see any questions at the moment.